The odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases.
One of the Fed's most important moments in recent years was just delivered at the July meeting. All eyes were on the infrequent disagreement among policymakers even as the central bank kept interest rates unchanged. Two federal open market committee members separated for the first time since 1993. The message was obvious. Even if one person advocated for a cut and the other for holding, internal support for the existing policy position is starting to erode. This change in tone occurred right before Friday's extremely alarming jobs report, which included significant negative revisions to the prior month's data, in addition to a weaker-than-expected July print. In May and June, the Bureau of Labor Statistics cut non-farm payroll numbers by a total of 168,000 jobs, suggesting that the labor market may be slowing down more quickly than the Fed had predicted. These changes have heightened anticipation for a Fed turn and renewed recession fears, with a 25% likelihood of an aggressive 50 basis point move. Futures markets are pricing in an 88% chance of a rate decrease in September as of this past weekend. And it's easy to understand why. Softening job growth, waning wage momentum, and an increasingly precarious employment picture are the current challenges facing the U.S. economy. It is evident that Macron's certainty is rapidly increasing when you consider the effects of ongoing trade disputes, growing tariffs, and escalating geopolitical stress, especially recent actions by President Trump regarding Russia. Cathie Wood, the founder and CEO of Ark Invest, not only supports the prospect of an impending rate decrease in the most recent episode of her monthly podcast, but she also views it as the last straw that will eliminate what she refers to as the last lingering uncertainty in the U.S. economy. Lower interest rates, declining inflation, and significant productivity gains, in her opinion, are paving the way for a strong economic recovery for cryptocurrency markets, which depend heavily on innovation and liquidity. That would indicate a return to rapid expansion, particularly if institutional investors seek out asymmetric opportunities following tighter monetary policy. We're delving into Cathie Wood's most recent forecasts, her rolling recession hypothesis, and the reasons behind her belief that a rolling recovery is imminent, one that will pick up speed in the 2026 election season. What are the implications for Ethereum, Bitcoin, and the larger risk asset class? Will the next significant catalyst for a cryptocurrency bull market be the Fed's shift? Let's begin. Scenery. Remember to like, subscribe, and leave a comment while you're here.
The odds for a rate cut in September are up to 88%, and a 50 basis point rate cut, maybe they're up to 25% or so. We think that will resolve positively as well. That's the one uncertainty. And the reason this matters is if people think rates are going to come down, then they're going to wait and see how low they go before they take major actions or make big purchases. So getting back to some kind of equilibrium is going to be important. And that is, we think, the last uncertainty before we move into what we believe will be a very strong recovery from a rolling recession, maybe starting with a rolling recovery, but gathering momentum. And we think by midterm elections next year, clearly on the up and up, with big upside surprises in real growth, productivity, and downside surprises on inflation. So that would be another positive because of productivity. We do know that there's some rumblings today, not rumblings, I guess. President Trump on Truth Social said he was moving 2 nuclear submarines toward Russia because of some provocative statements, it seems, or that he and Medvedev, who's Putin's deputy, have been having words. So there's that going on. So geopolitical risk, we don't think that goes away. And we don't know what's going to happen with Russia and Ukraine. It's unbelievable that it's lasted 4 years so far. The other uncertainties are China and Mexico. Most trade tariffs have been decided as of today, but China and Mexico have, I think, roughly 90 days, 90-day reprieve, so that's an uncertainty. But as I said, the biggest one is the Fed going to move? We think it will move now, even though Chairman Powell sounded quite hawkish this week in his testimony. So with that, let me go through some of these charts and visit first. So we will start with fiscal policy. Now, what's very interesting is year to date, the deficit as a percent of GDP has shrunk from roughly 7.3% to 6.2%. And as we add up all of the tariffs now, they're annualizing, it looks like, at $450 billion per year. So that would take us to the X you see here. I think that's roughly a 4.7% deficit. So we know that's going to happen. And the green line is 3%, which is Treasury Secretary Bessent's objective for 2028, the end of President Trump's term. Well, the 4.7% assumes no growth. And we do think growth will be slow until some of the uncertainties I mentioned are out of the way, but will pick up momentum. And we would not be surprised by the end of 26 to see this metric, deficit as a percent of GDP, at 3%, so 2 years ahead of schedule. So the bond market should appreciate that. And I do think investors, it will be a positive backdrop for equity investors as well.
For years, Cathie Wood has been predicting this, which she refers to as a rolling recession in which the economy contracts in segments rather than all at once. And she thinks we're getting closer to the next stage, a rolling recovery, given that the jobs data is turning, the budget uncertainty is decreasing, and interest rate decreases are probably imminent. There will be a gradual recovery driven by innovation and policy tailwinds rather than an abrupt V-shaped bounce. Productivity is among the most convincing indications. Wood notes that even while GDP is still low, productivity growth is accelerating year over year. These productivity spikes typically occur at the beginning of new economic booms. In contrast to previous cycles, structural technology development is driving this one in addition to cyclical forces. Technologies like artificial intelligence, AI, robotics, energy storage, blockchain, and multi-omic sequencing, according to Wood, are radically changing how businesses function, reducing expenses, increasing profits, and creating new markets. She projects that, over a longer time horizon, productivity growth might reach 5% or higher, something the U.S. hasn't seen in decades. That's significant because increased productivity frequently results in lower consumer prices, larger company profits, and more money being poured in R&D and innovation when wages and inflation do not rise in tandem. Put another way, it's the ideal environment for growth stocks, and particularly for cryptocurrency, which gains from both a greater willingness to take risks and the increasing importance of decentralized technology in the actual economy.
Here you see something interesting about R&D capex. You can see in the 60s, on the right-hand side, that the government dominated R&D capex spending as a percent of total R&D spending, 65, so roughly 2/3. And it has dropped consistently over the years, ceding that role to the private sector, which you can see on the left-hand side. So that's gone from roughly 1/3 to more than 75%. We think this is good, and it also highlights something very important from a venture capital point of view. The government, because of this phenomenon, really did launch Silicon Valley as it handed technologies to companies to develop in the 60s and 70s. And what you see today is the opposite, especially when it comes to space and defense. It is the private sector that is leading the government. And we actually think that is very healthy. And it is going to lead to a lot more productivity growth much sooner than otherwise would be the case. Now, I want to point out something in the tax package, the one big beautiful bill package. Some of these are pretty startling changes. In other words, they've never happened before. For example, structures, being able to expense structures in year one has never happened before. And it is now in place as President Trump and team are trying to attract more manufacturing back to the United States. It will be a little bit different from the manufacturing that left the United States, and with it jobs is going to be much more highly automated, but it will be here in the United States. But you can see these other three categories as well. Equipment we have seen in the Reagan Revolution. We had this kind of expensing on equipment, but not on the other two categories that you see here, and certainly not permanent. And that's what we think is so interesting. Roughly, I would say 75% of these tax changes, or 75% of capital spending, is going to enjoy permanent expensing. And that has never happened before. So this administration does mean business in terms of attracting manufacturing back to the United States. And we think this is going to be a very good thing. And we think the productivity associated with it is going to be astonishing, thanks to all of the automation and AI that is exploding on the scene today, now that the costs associated with both of them are dropping so quickly. So it's happening at a very good time. And so I've presented this chart before. The federal corporate income tax, while the explicit tax remains at 21%, incorporating the expensing that I just described will take the tax rate, the U.S. corporate tax rate, down to the 12 to 14% range. And the 12.5% range is significant because in the day, the Celtic Tiger, Ireland, began to attract a tremendous amount of manufacturing activity with its 12.5% tax rate. And now we are down at that level effectively. So now we'll go into monetary policy. As I mentioned, Chairman Powell sounded quite hawkish, even though reporters were saying, well, wait a minute, housing seems to be relapsing. And he deflected that. And, well, wait a minute, the metrics you look at in terms of core growth and core inflation, they're all moving in the right direction when it comes to inflation, and actually in the wrong direction when it comes to GDP growth. I think I'm not going to get the metric exactly right, but what Chairman Powell focuses on is real private domestic final sales, and that is running in the 1% range. And we saw that with the consumption figures, very slow. The consumer is becoming quite cautious, and beginning to lift the savings rate. We think that could cross 5% this year. But you see, money growth did start turning around. It was negative for quite a while. We're now up to roughly 5%. But when you get cautious consumers, that means the velocity of money, the rate at which it turns over, slows down. So the stimulative effect just isn't going to be there the way that this chart might suggest. We also know that the CPI, which is depicted in the green here, faces some tough comparisons. So I think we have two more tough comparisons at the 0 and 0.1% rate for the next couple of months. So the inflation rate could stabilize here, and maybe that's what Powell was responding to, just knowing that the optics aren't going to look great on inflation, meaning continued progress. But if we're right, that will be it. Then,
with interest rates declining, inflation slowing, productivity rising, and a rolling recession giving way to a rolling recovery, Cathie Wood presents an incredibly optimistic picture, all driven by exponential technologies like blockchain and artificial intelligence. Although her argument is based on long-term innovation and deflationary dynamics, it may minimize the short-term volatility of consumer demand, the persistence of core inflation, and the uncertain effects of trade policy and geopolitics. Raoul Pal's Everything Code provides a strong counterpoint in this regard. Pal considers more than just growth or rates. He emphasizes that the true factor influencing asset values is liquidity. According to his argument, markets are no longer constrained by high interest rates as they formerly were. In actuality, the longer they remain high, the more liquidity the system eventually needs to operate, particularly in light of the skyrocketing national debt and growing interest rates. He posted on Twitter, weirdly, the higher interest rates stay, the more they have to inject via liquidity to finance the debt, the higher assets go, the Everything Code. And that paradox is precisely what we are witnessing. Markets haven't fallen in spite of high rates. Global capital flows, balance sheet dynamics, and liquidity injections are all contributing to the stability of risky assets. That latent liquidity might pour back into the system if the Fed makes even a little shift, giving stocks and cryptocurrencies in particular a boost. Ethereum and Bitcoin flourish in settings where story and liquidity collide. They currently possess both. Thus, although Raoul Pal concentrates on liquidity dynamics and structural debt, and Cathie Wood views recovery through the prism of productivity and policy coordination, both arrive at a similar conclusion. Conditions are becoming risky again. The true question is whether you're prepared for the rally, not if it happens. If this type of analysis is helpful to you, please hit like, subscribe, and leave a comment. Do you support Raoul, Cathie, or both? Let's continue the discussion.